Dear listeners, thank you for joining us this evening on Mwango Spaces. We try to have conversations with management teams and with key people in the business world just to discuss what's happening in market and especially the results of companies. So it's our pleasure to have the I&M Group CFO today to dissect for us the financial results they just released so that we're able to digest a few of that and ask him a few questions as regards to that. Remember, this is Q3 results 2025. It's usually the last result released before the year ends. The next results will be around March next year. So I want to ask David to introduce himself. Maybe you can tell us a bit about yourself and what a CFO does, especially at I&M Group. And then for those who don't know, what is I&M Group?
Thank you so much, Eric, for that intro, and good evening, everybody. I'm excited to be speaking with you this evening. We're going to have a conversation unpacking the third quarter results for I&M. So my name is David Ngata, finance professional with over 25 years experience, varied experience, starting my career in audit for about a decade or so, and then have been in financial services for the last 15 years with one local bank before joining I&M Group, and before that with American Express in New York. Then coming to I&M Group has been around now for 51 years. Last year was a big celebration for us, celebrating 50 years since founding in 1974. Through that journey, we've witnessed tremendous growth. But over the last 10 years, we've really become visible in the market, and hopefully this conversation is a continuation of that visibility. When we introduced a series of strategies that we've been running on, we've branded them Imara. So right now we are on the third iteration of Imara, which started in 2024 and it will run until 2026. But this process began in 2016. And the whole import of Imara is to become East Africa's leading financial partner. Our journey is we started in medium businesses, which are now large enterprises and corporate banking, but now we are foraying into retail banking. As for those of you, especially those of you who are in Kenya, you may have seen us increasing our branch footprint across the country.
Let's now dig into the Q3 results. Maybe you can start with the bird's eye view and then you dissect segment by segment, maybe going into the regional subsidiaries a little bit, the profitability and what drove it, and the dividends much later. So let's start with the broad overview. Can you give us like an elevator pitch on the Q3 25 results?
Okay, sure. So we're very excited with our Q3 results, which we announced early this morning. So 26% profit increase year on year. But to really understand those results, I just spoke to the Imara 3 strategy, which began last year. So in 2024 itself, for the full year, profitability growth was 25%. So this is a continuation of that momentum. So 25% in 2024, 26% 9 months in. That growth, we are witnessing it across all of our regional subsidiaries. We have banking subsidiaries in the region on the markets of East Africa, as well as in our non-banking subsidiaries, especially in Kenya. I know those do not get the prominence as such, but their performance has increased spectacularly during the year. That is despite the varied economic situations in the region. We've seen each of the subsidiaries contributing to these 26% profitability growth and 27% profit growth after tax.
Now let's get into a bit of the subsidiaries. The subsidiaries contribute around 23% of group profit before tax.
Yes.
How important are they to the overall portfolio? And then once you've given us a bit of a broad overview, can maybe tell us how Tanzania, Rwanda, Uganda, and just Mauritius are doing each as a segment?
I'm glad you've referred to the subsidiaries as a portfolio. So we run a portfolio of businesses within the region and in Kenya across the various business lines. Our portfolio has performed well. So subsidiaries are contributing 23%. But as I noted earlier, we have to think of our results as a portfolio and in the context as well of 2024. In 2024, the subsidiaries were contributing 27%. And therefore, what we are seeing this year, now going to each of the subsidiaries, is increased momentum in profit growth for our subsidiary in Kenya, I&M Kenya Bank, which is the oldest subsidiary. Last year, profitability was growing at, for 2024, 17%. That has improved this year to 26%. Then what we are seeing is, let me call it some sort of maturation or eliminations of one-off events that were there in our subsidiaries in Tanzania and Uganda. So last year, Tanzania subsidiary increased its profitability about 240%. And this year, that is about 9% on Kenya shilling basis, and then about 14% on Tanzania shilling basis. Then one of our most exciting subsidiaries and also the oldest bank in Rwanda, which last year we had growth for the full year of 57%. This year in Kenya shilling, it's growing 21% in profitability. That's driven by, we must remember, Rwanda is one of those countries where we have had spectacular economic growth, averaging about 8% the last 3 years. On a Rwanda franc basis, that subsidiary has recorded about 47% growth, but Rwanda franc has depreciated relative to Kenya shilling. Kenya shilling has been very stable, and it's a reporting currency this year. So that 47% growth, when it translated to Kenya shilling, comes to about 21%. Uganda, we are seeing a decline this year, but in Uganda subsidiaries, we had grown 78% last year. They were what I would characterize as one-offs in our profitability for last year, in the sense that we had significant loan recoveries that contributed to our profitability. We don't have that this year, so that explains the decline. But we will see that momentum starting to build, and as we close the year, the fourth quarter of the year, and into 2025, we should see Uganda balance sheet starting to elevate or uplift the earnings potential that we have in that market. And then finally, for Bank One, the growth in Mauritian currency, we have grown Mauritian rupee about 4 percentage points. But then again, Mauritian rupee is another currency that has depreciated, and we are showing a decline of about 9% to the group portfolio profitability. Then I did speak to the non-banking subsidiaries. I know we don't focus a lot on them, but I think we should start doing that. Which last year, at a time like this, the contribution to the group profitability was about 400 million, and that has increased to about 1.1 billion. As we do have a wealth management business, we do have a bank assurance business, and those subsidiaries do earn us a good fee income. So that's the overview, subsidiary by subsidiary, breaking down business.
Excellent. So when you look at that portfolio of a subsidiary,
yes,
where do your strengths lie in that portfolio? And do you see it expanding, maybe joining some others, so maybe considering going into Ethiopia or something like that? Is that something that is in your time horizon?
We want to be East Africa's leading financial partner, and East Africa is bigger, not necessarily the market that we are in. So that's a possibility. Is there something that would like to share at this point? No, there's nothing active. We look at all the markets, we look at all the opportunities. We have now the banking license, we have the non-banking licenses, we have invested in digital capabilities. So as we expand regionally, we will now try and figure out which of the capabilities and license we should deploy in what market.
When you come back home to Kenya, now you look at your portfolio, and then let's look at the main business. PBT was up 26%, and there was 21% increase in operating income. Could you give us a flavor on how the bank performed in Kenya?
Yes, Kenya Bank, we're very pleased with our performance. PBT, as you've said, increasing 26%. So Kenya, we've seen the interest rates coming down, the policymakers and the government being very keen for private sector credit expansion. However, when we look at the banking sector, that has been slow to pick up. It's starting to pick up. And therefore, when we look then at the Kenya balance sheet positioning for whatever growth funding we had in deposit, we deploy that in government securities, and we have then been able to get increased interest income on government securities. Then the other element, as the rates come down, sure, then when you're passing that benefit to the customers, the benefit of the cost save on the funding side, when you're passing that to the customers, we do it in an agile manner and also in a thoughtful manner that makes sure that margin is considered and is there. Then the other element in Kenya that we've seen in our business is expand distribution footprint in form of branches. So when you look at that and you look at our results, then you will see that investment coming through in increased staff costs, especially. But we've been very disciplined in growing or in controlling in the cost containment of the other costs, the growth of the other costs outside of staff cost, that is in the single digits. And that then speaks to how we've been able to achieve the results that we've just reported.
And then if you look at the loan growth yourself, a lot of your peers are struggling with loan growth, right? Looking at your numbers, you grew loans at 7.3% and expanded deposit by 10%. You're competing with MMFs for these deposits here and there. For loans, it's a tepid loan environment, so 7.3% is pretty robust. What's the secret sauce here for you?
For the Kenya business, so the numbers, the 10% and the 7% loan growth that I think you refer to, that's on the group side. On the Kenya business side, we're operating in the same credit environment. We want to support the private sector, but we also want to make sure we maintain underwriting standards. So we've seen the Kenya loan book itself 2 percentage points. So the 7% for the group, largely that comes from markets such as Rwanda and Tanzania, where the economy has been a lot more robust. However, on the Kenya side, the depositors continue to trust us and see value proposition in holding deposits with us. And we did see those deposits increasing about, I believe, 8 percentage points.
Yes, I think the deposits for the Kenya side was around 10%. But then what can you learn maybe from the regional perspective that can help the Kenya drive a bit of loan growth, which has been a bit of a bother for most banks for the past 2 years or so, even as the central bank keeps trying to lower rates to ignite that bit of lending to businesses. There's still a lot of increase in terms of lending towards government. What needs to be done to ignite that?
I think that we will have sector by sector rotation and really be there are sectors, even in the current economic environment, that are doing particularly well. There are sectors which are not doing as well. Tourism, agriculture have done spectacularly well. Real estate, manufacturing, not as well. But what we are seeing in Kenya, especially given where the rates are, based on our pipeline, we should start to see that credit expansion. I think that will be there for us and also across for the industry. The central bank itself has indicated, I believe, starting September, positive numbers. We're still in the single digits, but should this momentum continue, then we should see the financial sector and ourselves starting to grow our loan book at a meaningful clip. But in terms of lessons, I think then this speaks to the portfolios where the economic conditions in one market are balanced out by another market. So whereas Kenya, we have had the situations that we have had. In Rwanda, it's been a story of 8% GDP growth year in, year out over the last 3-4 years. And we have seen credit growth in that market expanding as well as in Tanzania.
I think it's a good point also maybe to pitch the bank itself. What's your value proposition to customers mostly? And then I see your NPS score is around above 70%. So maybe you can pitch for us, why should customers be banking with you and why are they banking with you? When you talk to them, why do they prefer you?
We are very thoughtful about the value proposition that we want to create for the customer. We want the customer at each stage of their life journey to be able to see value in us. If you're, let's say, a younger customer, very much digital and doing a lot of payment on your phone, you may be familiar with our Nisari proposition, which no matter how many payment transactions you do to mobile phones, that payment, as long as it's coming from our bank, it's free. You can imagine then to that cohort or demographic of the society and also to the small business, what that means when you speak to the smaller businesses, the cost that goes with the receiving or completing of business transactions sometimes can be prohibitive, and the fact that you're stepping in and saying, we will offer that. Then when it comes to the corporate, that has been our bread and butter and our foundation, and really you will see us being able to offering differentiated and deep customer engagement. We will see us coming through with capabilities around trade finance. When we look at the market share statistically, I believe we are the second largest trade finance bank in the country. That's another value proposition then that will be offered to the corporate sector. And then trying banking the ecosystem, where we start off with the big entities and working to see who their vendors and who their stakeholders are, and making sure that we are banking that ecosystem. When we look at our current Imara 3 strategy, it's actually anchored on the ecosystem banking, having the right value proposition for retail, and then deepening our engagement with the corporates.
Looking at the group, there's gross NPLs declined, I think, by 7%. Then net NPLs were even down much further. Provisions were up. How do you square those two?
So firstly, the decline in the NPL, the way to think about it is we've been thoughtful around credit monitoring and credit underwriting standards. So making sure that we maintain those, we have rigorous underwriting and rigorous monitoring. So that speaks to then not having new downgrades or new significant downgrades that builds onto that number. And we've been able to do this year to date, and we did this again last year. So steadily that NPL gross number has been declining. Then the way to think about then the level of provisioning is, even though we have rigorous monitoring and rigorous underwriting, which makes sure that we are not getting significant downgrades and increase in build up in the number, whatever we have, we are also thoughtful as to how we're going to recover, and we have the courage to take the provisions when required. So that speaks then to the increase that you're seeing in the provisions in the P&L. And I should also state that we forayed into retail business, so that does come with a new understanding of that line of business. And generally there we'll have short-term loans, and whatever you don't collect within 90 days or after that, you have to quickly then make a provision for that. So that does speak to the increased level of the provisioning, increased level of then coverage on the NPL, and then the outcome of that is the reducing net NPL number that you refer to.
And then if you look at the numbers, especially investment in government securities, I think it's slightly more than doubled, if I'm looking at the numbers correctly. Is that deliberate in terms of just channeling some of those deposits to government, just parking them there as you look for places to lend to?
Yes, that is correct. Our customer deposit funding by our customers has continued to increase. And in the meantime, then we have to deploy those funds in a place where we can earn a return. And then when the opportunities are right, then we can move that over to the private sector credit growth.
In terms of the reallocation, then a lot of the banks, they're doing the same thing in terms of parking the cash a little bit.
Yes.
What needs to happen to channel those funds towards actual businesses that need to be lent to?
So I think that's a broad macro question. What's need to move? I believe, and I think the regulator, the central bank. So firstly, a bunch of things that have happened that are indicative of a good macro outlook. In Kenya and as well as the region, inflation is stable. So 4%, I think this is one of those long periods where we have had this much stability in inflation. Exchange rate has also been very stable. We have seen the rates coming down, so that means credit affordability improves significantly. And therefore, those proposals, which when the business sector or the private sector, when they do the proposal evaluation, and they use the whatever cost of funds model they use, previously something that was a project that probably didn't make business sense when discounted at about 18%, now starts to make business sense when it's being discounted at about 13%. So we will see those projects then, or the sponsors behind those projects then starting to have the confidence to come to their financial partners for funding. And that level of the stability that I've spoken to and the affordability is, I think, then what the central bank starting in September started referencing to about increasing private sector growth. I think it should start as a trickle, the way the central bank reported it, but we will see more momentum.
Thank you for that. And then if you look at the net interest income, the non-funded income, how's the trends in that in Q3 25?
On the net interest income, that has improved. or has grown. On the funding side, the funding levels have grown, and then we've been able to deploy that either then in loans or government securities. And we've been able to also make sure that the benefit that we realize on the cost of funds, we are passing that to the customer without impairing the net interest margin. But then on the non-funded income, that, as you may have seen in our results, then the foreign exchange income, that is lower than last year. And I think that's an industry-wide issue, particularly in Kenya, where the shilling has been stable and the margin has really compressed. But outside of that, we have seen other sources of income, fees and commission. And on a group-wide basis, I did speak to our non-banking subsidiaries that offer complementary value to the banking subsidiary, I&M. So this is the wealth management side, especially where we've seen customers continue to invest and the assets under management continuing to grow. We have about now, third quarter, close to about 90 billion assets under management, and that does give us fee income. Being able to give the full or comprehensive value proposition to the customer has meant then that we are able to grow our non-funded income, even as we have had a decline in forex income, and therefore the growth that we've witnessed in the other lines have been able to more than offset the FX income decline.
And the FX decline, there's been a bit of debate on social media and at least generally in capital markets on whether the shilling is a bit too stable. What do your clients tell you? Are they comfortable with the range at which the shilling is trading at, or do they feel like a bit of maybe volatility to be allowed would be good for them?
I think for our clients, it's been more the fact that they have had the confidence. If I want to have a USD order of 10 million, it can get filled immediately or within a very short period of time. And if I needed to sell 10 million USD, then that can happen. And that stability, as I said earlier, then it does build into the business confidence, where then I can be able, or the business partners can be able to plan better. What we have seen, I would say, yes, a bit of volatility maybe would be good for the margins, as we've seen then the shrinkage in the FX income across the banking sector, but stability is good for everybody.
My next question is about the new CBK pricing framework. I think you have had a look at it. It's supposed to start early next month, December 1st. We are almost 10 days to, or 11 days or so. And then the implementation is supposed to go on until, I think, February next year. I think that's when fully should have transitioned. What are customers saying about this? And what's your take perhaps as an industry and as a bank in terms of your preparation in this regard to shifting to this new model?
Firstly, we have had a lot of engagement as the banking sector amongst ourselves as a KBA. We've also had very good engagements with the regulator, the CBK. And as the banking sector, we are supportive. Transparency is good. It's good for the customer to be able to compare pricing between two institutions. However, there are a few things within the model which we've raised, which I think they don't stop the implementation of the model, but they would need refinement and being looked into. And we've communicated, and as a banking sector through the KBA, we've given that feedback to the regulator, and we are working very cordially on that. So is it a good start? Yes, I think it does work to develop our market. Are there implementation handles to overcome? Yes, but that as maybe internationally, even as we saw with the transitions from LIBOR to SOFR, there were some problems that needed discussion. I think the only difference is that transition was probably a 2-year timeline. Here, it's been a 6 months, 8 months timeline, but we welcome the challenge.
For those who are uninitiated in this regard, what does that new pricing model look like vis-a-vis the current model?
I think what the CBK and the foundation of the model has been to delink the monetary from the physical. So we know the government financing, the physical deficit is covered through borrowing, either in treasury bills, treasury bonds, and infrastructure bonds. whereas the monetary aspect are driven through the central bank reference rate. And one of the rates that's critical to that is the interbank rate, which has been closely tracking the central bank rate. And therefore, the biggest move is the fact that the starting reference rate now moves away from being the treasury bills, either the 91 6 months treasury bill tenor, which has tended to be the market practice, to now this Kesonia rate, which is really the interbank rate renamed Kesonia. So that's the biggest shift. The thing to that is then when we look on the funding side, our customers' reference point for cost of deposits, they will look at the opportunity cost and what else they can do with their money. And I think that continues to be the treasury bill rate. But CBK and the discussions that we have had as an industry, the model does allow for the interest rate differential, should there be any, between the interbank rate and the treasury bill and the deposit rates, to be included in the model as part of cost of credit pricing.
And then for yourself as a bank, when you examine the impact it might have, do you see any high-level impact that it might have that you may want investors maybe to be informed of beforehand? It doesn't need to be specifically, but maybe a few items here that maybe will be affected by this change.
Now, we anticipate it's going to be margin neutral. The transition right now, especially the way the market is, there's alignment between the interbank rate, the treasury bill rate, and therefore we don't anticipate any immediate impact. And the fact that, as I say, then you can adjust for any differential that arises over time in the cost of funds between the interbank and the cost of funds. We expect then this to be margin neutral, and we don't anticipate in any way it's going to impair our earnings.
Now, let's switch back to the income statement a little bit. Specs, I think excluding provisions was a bit up, maybe in the double digits slightly. Staff costs, I see they're up. Is there something good for you? And like you're investing in your staff really well to make sure that they're world class in terms of delivering value for customers and investors in the long run?
Yes, we're investing, one, in talent, deepening our talent, but also as we have expanded the branch location, each of these branch locations needs to be well staffed. We need to give seamless for the established branches. We need to give the same level of service in the new locations. And therefore, we have had to staff that. That does explain the increase in the staff cost, and it's a good investment that we are making. That really has been the significant driver of operating expenses outside of loan provisions. The outside of staff costs, other costs, all in aggregate, we are seeing just an increase that's slightly above, about 200 basis points above the level of inflation.
Let's talk now about CapEx. We finished on OpEx. CapEx, any plans in the next year so that you would think would be major investment that you're making in terms of maybe building up one of the subsidiaries or perhaps just strengthening some of the branches of the bank in the country itself? How has been the CapEx trends going so far, and how do you expect them to evolve going forward also?
So the biggest CapEx element is around continuing to invest in innovation, especially digital capabilities. Yes, branches, and actually when we think about our distribution channels, it's a combination of physical and digital. And when it comes to digital, we have to invest in making sure those capabilities are secure. So we will continue enhancing and revamping in cybersecurity capability. We will continue introducing new capabilities to our customers across all of our markets, and making sure that we bring convenience to our customer, and both convenience and choice to our customers. If they want to transact digitally, they can. And if they want to come to the branch for a touch and feel kind of service, they can. And therefore, we've been investing in this over the past couple of years, and we will maintain that same momentum. So we do anticipate CapEx spend, but not in a significant number that does impair or that does move our capital. And speaking of capital, you will note that capital, our shareholders' funds, now that has increased tremendously, so it can support this investment, or it can support a larger threshold of both physical and digital investments.
And then speaking, of course, a bit of CapEx and growth, part of growth can be organic, and then part of it can also be M&A. And given the rising core capital requirements from the CBK for Kenyan banks, there are opportunities to pick up some of those smaller banks that may not have the requisite capital. Is that something you're considering as a group, or are you always on the lookout for opportunities for, maybe you focus more on organic rather than acquisitive growth?
Each opportunity has to be evaluated on its own merit. Nothing really at this point to discuss on that aspect. We need to evaluate each opportunity and what that does to the existing business that we have. And that will be the case whether in Kenya or when we're doing geographical expansion.
If you look across the markets that you operate in now, what are the dynamics that are operating in some of these markets that you're noticing? Maybe they may not have fit the narrative so far, the discussion so far. What are some maybe learning points that you're picking across the markets? Maybe say Rwanda or Uganda or Tanzania or Mauritius.
The markets are somewhat similar. If you look at Kenya, especially Kenya, Uganda, Tanzania, GDP growth has been separated by a few basis points. Those three countries have oscillated anywhere between 4.5 to 6.5 over the last 3 years. I think Rwanda is the outlier one. The dynamics are somewhat the same. We have the same population mixture where we have very youthful population in all of our markets. And therefore, being able to, I did speak earlier to something like Nisaret, something that resonates strongly demographically. That is something that actually for us resonates in each of the markets.
Now, we're coming to the last few questions. One of them is on capital allocation, and I think the interim dividend was up from 1.3 to 1.5, around 2.6 billion that you're unleashing on shareholders before or after Christmas. I haven't looked at the key dates. Maybe you can highlight that for us. Now, how does it pan out, like your strategy in terms of the returning capital to investors, or just returns to investors generally? How do you think about that? Are you shareholder first also in terms of your thinking when you do capital allocation?
Yes, and we have to be mindful and very thoughtful in what we do with capital. And if we do have internal opportunities which we think will be value accretive, then we will deploy capital to those opportunities. If not, then the best way to create value for the shareholders is by being able to return capital to them in form of dividends. As you note, we did pay an interim dividend last year. That the fact that we paid an interim and we paid a final, and we had a good dividend payout of about 30%. And that has had, we have had enough capital to be able to fortify our businesses should need arise. You may have noted when we did report the first half of the year results, for instance, we deployed additional capital to Tanzania subsidiary where we are seeing opportunities for more growth, and we will continue to do that. But our internal capital generation and considering the resources that we are holding, we did feel it was a good number, or it was good to pay the shareholders an increased amount by about 15% from 1.3 to 1.5 this year. And you did ask about the payment. The payment will be happening just about mid-January, I think specifically on 14th of January.
Our market is mostly dividend driven, so it's always good to see a group do well and at the same time share that wealth with investors, so to speak. Speaking of, the share price is up 27% this year. I think that's created the wealth of around 16 billion to investors this year. What would you attribute that to? And when you interact with shareholders, how are they feeling about the group and how you're performing? And probably a good time also to pitch to our listeners on why they should be invested in I&M.
Maybe allow me then to go back to the beginning of our Imara 3 strategy. So when you go to 1st of January or end of December 2023, share price was about 17.50. Now it's when we close the quarter, it's 43. So the growth here has been about 140% return. What does that mean? I think it does demonstrate. So maybe I'll echo Warren Buffett here, where we say in the short term, the market can move up and down, but over the long run, then the market is a weighing machine and it does weigh the value. That growth, we've seen the broad stock exchange having a good year this year. So there's a bit of that, but within the 150 with the 140% return since Imara 3, we would like to believe there is a manifest value from our execution of the strategy. and we will do our best to make sure that we continue creating value for our shareholders.
Given your journey and reflection on your journey, what would you tell young analysts and investors who are listening in from your growth journey? What can they learn? And also share with us some of the books that you're reading currently. And perhaps also one reflection about the year 2025 as we close the year also next month.
I think it will sound cliche, but you've asked the question. I would say hard work does pay, and I'd say also life is not linear in the sense that the opportunities do not come at the time that you anticipate them to, and therefore maintaining, it's important you have the right context and you maintain focus season in, season out. If you do that, similar to investing, again, I'll use Warren Buffett for the long run. If you are disciplined and you do what you need to do, you will do well in the long run. So things may happen in the short term, but in the long run, you will do well. Around the type of book that I'm reading on my table right now, it's a book Influence by Robert Cialdini. It's a very important book around human psychology. So probably for those of you who are interested in that genre of reading, I would highly recommend. And for those of you who are not, probably I'll say it may pull you in that genre of types of books. That question.
Reflection on 2025, perhaps, and how the year has been for yourself.
I'm thankful. It's been a good year for our business, a good year based on the results that we are reporting. Very thankful, and I feel very privileged to be a steward, to be playing a small part in this result, and thankful for the good health.
In closing, as you prepare, the group 2025 is done. It's a month to the end of the year. 2026 is up around the corner. What are you thinking as a group and as an institution as you head into 2026? What are your hopes and plans, and just some reflections as we close the year and go into 2026? You can put that in context to your long-term strategic plan that you call the MARA, and then share with our listeners what they should expect in the full year as you go ahead.
We generally do not give outlooks in terms of numbers, but I think last year, this year, we've demonstrated that we can create value for our shareholders and for our stakeholders. When we're looking into 2026, we want to continue doing more of the same, doing it better, elevating our game, and delivering more. There will be 2026 will bring its own different sets of challenges, but we have been resilient and been able to navigate the challenges that have been there through 2025. And we do anticipate and look forward to navigating the same in 26.
Thank you so much, David, for taking your time to discuss with us the results for the group for Q3 2025. We look forward to hosting you also in the new year to be able to discuss the full year results and to put them in context once again. So thank you for your time. For our listeners, thank you also for making time to listen in on the spaces today. I'll give back to you, David. You can give us your closing remarks and then invite people to work with you.
Thank you, Eric, for this time and for the session. Hopefully, us done a fair job of unpacking the results for Q3 2025. We look forward to closing the year strongly, and we look forward to, again, having a conversation when we have the full year results available. I would like to thank all of you for making the time. It's evening, so there are other things you could have been doing, and you chose to be here and to listen to this. Thank you so much, and I wish you happy holidays as we approach the close of the year.